Good evening. So I have this unfortunate situation of between you and the refreshments. This is a tricky one, so I'll try to be very concise. So we all live in interesting times, as the saying goes, and each of us has their own version of that predicament. Mine is waking up every morning and wondering when I pick up my phone if I'm going to have to rewrite the economic outlook entirely based on what happened overnight. But more seriously, I think one reason why we're struggling a little bit is that there's so much happening at the same time. And so to continue with the puzzle analogy, what I'm going to offer you to decrypt everything that's happening right now in the global economy is a puzzle in three pieces. So three pieces should be manageable. Piece number one is resilience. Piece number two is rewiring. And piece number three is realism. And these three pieces, when you put them together, it makes something pretty steady, something that sticks together well. And that's, I think, why there's so much activity at the end of the day. So let's start with resilience. Resilience of activity. We keep getting hit by shock after shock. We had the pandemic. We had the steepest hike, the steepest tightening cycle by central banks around the world to kill inflation. We land in 2025, we think that's it. We're now welcome to the new normal, things are gonna be good. And guess what? We get a quintupling of US tariffs, the whole show of Liberation Day. Everybody thinks that's it, we're gonna get a global recession. We didn't. We didn't. In fact, we all ended up revising up our growth forecast. US grew by a little above 2%, Europe grew by 1.5%, which for Europe is a very great number. Unemployment remains near historical lows, and we defeated inflation, and markets did wonderfully. So that was a great year. We had great momentum coming into 2026, and then we get hit by the war in Iran and what the head of the International Energy Agency described as the largest energy supply shock in history. And so the question is, can we repeat this feat of last year? Can we again avoid a recession, preserve growth and resilience in activity? And at this hour, I would say kind of yes. Now, of course, this could change by the end of my spiel because President Trump is once again threatening to attack Iran again later today. So all bets are off. But no, it shouldn't be a laughing matter. It's the truth. But on the strong assumption that the situation in the Gulf does get resolved in the next few weeks, and therefore oil prices don't go much above the sort of $100 per barrel range where they've been for the last few weeks, our sense is we are going to still see a lot of resilience. Sure, the growth story is not going to be as good as it would have been without this episode. We need to shave off maybe 0.5 percentage point of GDP for advanced economies from the initial year forecast. So for Europe, we land a little under 1%. It's not great, but still okay. For the US, we're still, well above 2%. And for emerging markets, it's even better because, in a way, those that don't have oil have AI to keep them growing. So we barely need to revise down the outlook. And then Latin America, others who don't have AI, they have oil and other commodities, so they're okay. So by and large, not as strong growth as we would have had without this, but should be okay. What is a bit more problematic is inflation, and we're already seeing this almost everywhere. Inflation almost certainly is going to be higher by about 1%, and that's going to have some stickiness to it. So these are the main characteristics of the outlook. Still not a big problem about activity, about employment and all that, so that's the resilience story. A big part of why we see that resilience is because of the structural rewiring that is happening underneath. And there are three dimensions to this. The first one is geopolitical. The rules of the game within which the economy operates had been pretty stable for the last several decades. And all of a sudden, we have to accept that they're gone. I mean, some of them are fully gone, some of them are still here, but they're not being respected by the #1 economic and military power in the world. So, it's not clear what they're here for. And we are now in a world of, raw power, strategic competition of everyone amongst everyone. And it's a problem because we spent the last few decades building massive interdependence because that was very efficient. So we're in this space where the global economy has become a battlefield, and we're all, at risk of, having this interdependence weaponized against us. So that's a, big paradigm shift, #1, and that's gonna be with us for a long time, several years, maybe a decade. Paradigm shift #2 in the economic area, because of this interdependence, as well as climate change and other things, we're in a world of constantly getting hit by supply shocks. Some commentators have called it the revenge of the physical world. Geography matters, access to molecules matters, and if you can't get them, you can have your entire business model thrown out. So that has big implications in terms of how corporates manage their affairs. It creates a lot of investment needs. You remember Larry Summers talking about secular stagnation before the pandemic, back when large shares of the global bond markets were having negative yields. The story was too much saving in the world, not enough investment. Well, this is gone. We're now in the early stages of a massive CapEx cycle to rearm, to build infrastructure for energy transition, to build infrastructure for digitization, to build infrastructure for resilience against all these shocks. And what does that mean? Higher cost of capital for the very long foreseeable future. Again, not a bad thing if you're a lender. If you have too much of it, good for you, right? But it's an adjustment to make. So constant supply shocks, higher inflation, higher cost of capital. And then the third paradigm shift is a technological one. And here the main story is AI. But AI, one tends to think of it as something about the tech sector, but no, AI is going to change everything. It's going to change the tech sector, it's going to change finance, it's going to change life sciences, engineering. And again, we're at the very beginning of it. It's going to create lots of winners and losers, and it's going to keep everybody on their toes. And then in finance, on top of that, completely independent of AI, there is the whole tokenized finance revolution, also in its early stages. But if you believe a survey of finance professionals published by the ECB last week, for almost all activities of financial activities that you can think of, except traditional loan issuance, the majority think that within 8 years, tokenized finance will be the dominant form. 8 years, that's the day after tomorrow. So you've got all these huge changes, and the good news in all this is that this is met by policymakers so far, mostly with realism. Realism in fiscal policy. The sad truth is almost everywhere public debts are too high. There is no fiscal space to do anything much anymore. And so governments have been very moderate in their responses to the latest shock, unlike in 2020 and unlike in 2022, when governments were happy to give checks to everybody and spend several points of GDP in support to the economy. This time, that's not the case. That's good, has to stay that way. Otherwise, bond yields, which have already gone up a lot since the start of the war, will be getting a lot higher. We're talking 50, 60 basis points in Europe, close to 70 basis points additional on the 10-year in the UK. These are very large moves. We don't want this to go higher. Well, depends. At least governments don't want this to go higher, and taxpayers don't want this to go higher. Realism in monetary policy. By and large, central banks are reacting in a way that I find quite balanced, not coming out all guns blazing, we're going to do a massive tightening cycle to kill inflation, not repeat the mistake of 2022, but they're also not being negligent. And so I think, we're going to get a rate hike from ECB tomorrow, but they're going to be very cautious in terms of the next steps. And when it comes to the Fed, whereas there was until recently, a lot of anxiety around, well, Kevin Warsh, and is he going to do the president's bidding, et cetera. But I think now the market is reasonably realizing that all the data is pushing towards rate hikes, not rate cuts, and this is likely to be delivered. So again, that's good. But where the policy realism is the most interesting is on everything else than fiscal and monetary. It's the structural policies. Industrial policy is back. Every country in the world right now, their number one priority is strategic autonomy and resilience. And that means spending money to reduce dependencies on China and countries that are considered as not friends for critical supplies. That means supporting domestic industries. That means thinking very differently about free trade. And in the case of Europe, most interestingly, that means that we really need growth, because otherwise we can't afford to do any of that. And there's been really, in my view, a sea change in it's never enough, I know, so some of you will think, no, but they need to do more. Yes, they need to do more, but I think the EU supertanker has started veering in a much more growth-friendly direction. They're not used to this. They have to work up the muscle to do the right thing. But the pivot is very clear. We see it with the package they announced last year around supporting tech and innovation, which uses much more a US approach of carrots, not sticks. We've seen some encouraging developments on banking regulation, on capital markets union at last. And I think there's really now a desire to move. And if we can't move with 27 countries, we move with 6, and that's okay, and the others follow when it's... And so I think that we're going to see a lot. I think actually Europe, people have very low expectations, especially outside of Europe, and I actually think Europe has what it takes to outperform. So long story short, it's a confusing time, it can be a stressful time, but it's a time of incredible opportunities, and you just have to be sure that you're on the side of the winners and not the losers. But for me, I'm super bullish, and BNP can help you be on the right side as well.